Okay, folks, welcome back. I was going to say good morning, but I guess it's afternoon for most of you. Okay, let's get started. We're at 12:30. A couple of things. One is if you're keeping count, we're getting towards the last third of the class. So we're marking time, right? Because we have 4 weeks left in the class. Last class is on May 10th. And I did send you the date. The date for your final exam is May 17th, which is a Monday, which you get a week after the last class. The final project is due May 10th. The reason I'm bringing that up is you've noticed I haven't nagged you about the project for a while because I gave you a case in the middle. You're going to see the nagging begin this week because you do need to get the numbers together if you haven't really been working on it, and start to move into the next phase of the project, looking at the mix of debt and equity to accompany the right kind of debt. Are there any questions before we start? Okay. So here's what we're going to do today. We're going to continue with the trade-off on debt versus equity. Make sure that I've got that. We're going to continue with the trade-off on debt versus equity. We talked about the two biggest benefits. The first and biggest benefit of debt is the tax benefit. Interest is tax deductible.
Is the class recording?
Oh, yes, I think it is. Let's see. Yeah, it is recording. Thank you for reminding, though. Yeah. Cash flows to equity are not. So the higher your tax rate, the greater the benefit to borrowing money. Keep that in the background as you hear, because in the next few months, we're going to hear this debate about corporate taxes. What should the rate go up to? And we can talk about the good and the bad of raising rates, but this is something that's going to be in the background. The second benefit of debt is a little more subtle, which is if you have a company where the management is not particularly careful about picking projects. Why? Because they have a lot of fat, a lot of airbags built in, cushions against mistakes. Forcing that company to borrow more money can make it more disciplined. So those are the two big benefits. The first and biggest worry when you borrow money is bankruptcy. You expose yourself to the risk that you will not be able to make those contractual payments. And if that happens, you worry about the consequences. And the way we measure bankruptcy cost is we look at the probability that you go bankrupt, which is a function of how volatile your earnings are, how predictable they are, and the cost of going bankrupt. And I broke those costs down into two parts. One is the direct cost, which is what happens after you declare bankruptcy. You end up in the court system and they suck up all your assets. The other is an indirect cost, which is if people think you're in trouble, you're in trouble. Customers stop buying your products, suppliers start demanding cash, employees start
we lost the slide. Sorry to interrupt you. My bad.
Let's see. None of you can see my slides?
It's just black.
You see the box, but it's black. Oh, there it goes.
But I think it's really my broadband that's fading in and out. Let me make sure that. I think it's let me turn off my audio for a little while. Maybe my video for a little while. Maybe that'll make a difference. Yeah, it's definitely an internet problem.
I could see them now. Can you guys see them?
Okay, I've turned off my video. It should be better now. Everybody should be able to see the slides now because without my video trying to take up. So I'll go off video for a little while. I mean, you can hear my voice, you can see the slides. So bankruptcy cost comes from both the probability that you go bankrupt and the cost of bankruptcy, the direct cost and the indirect cost. Let's move on to the second cost of borrowing money. Whenever you borrow money, and we talked about this last session, we create a different group with a very different set of interests. What am I talking about? Let's suppose half the class ends up being shareholders in the company, the other half are lenders to the company. What shareholders want is to maximize value. They're going to go for growth and potential and all that good stuff because they get the upside. Lenders want you to be much more conservative. Why? Because they want to be paid back. If every company in the world was run by the bankers who lent to the company, you know what companies would never do? They would never invest in projects. Why would you ever want to invest in projects? Keep the cash, pay the debt, that makes me better off. So you've created these two groups which have conflicting interests. In economics, the costs that are created when you have two groups with conflicting interests is called an agency cost. In the context of debt and equity, here's the form it takes. If you're a banker, you lend me money, and you lend it without any strings attached. As an equity investor, I'm more likely to take that money and take very risky projects, or even pay myself big dividends and use it for stock buybacks if you don't stop me. So I'm going to give you an analogy where I think agency costs are much more relatable to, which is very much like debt and equity. Do any of you have kids? Dan, you have a kid? Do you ever have a babysitter? No.
Yeah,
It's been a long
sometimes.
time, pre-COVID, no?
Yeah.
This is a classic agency problem. No? When our kids were very young, I mean, once every year, maybe twice every year, you'd have a babysitter. You're going to see very quickly why it becomes only once or twice a year. It's a huge production. It's like 4 weeks ahead of the event, which for you is just going to the movies. You got to get the babysitter lined up with backup babysitters and backup to backup babysitters just in case they fall back. The big day arrives. The babysitter is like 10 minutes late. That's kind of a standard. Comes rushing in, and you give the instructions, and it's a whole set of instructions. Please get they've been fed. They need to get to bed by 9. Don't feed them any candy. No sugar before 9 o'clock. Make sure they're in bed by 9. Then you leave. Now let's think about the incentives here. Your incentive is when you get back home, you want your kids in bed sleeping, hopefully through the night. Your babysitter's incentives are very different. They just want to get through 10 o'clock or whenever you're planning to come home. And whatever makes it easier for them, they're going to adopt that path. So 8:30 comes around. You've been told they need to get no sugar, get them to bed by 9. Kids sense weakness. So they come down and they realize the babysitter really wants to watch whatever she's watching, Gossip Girls or whatever she's watching. Come down and say, I want ice cream. And the babysitter says, no, your parents told me no ice cream. You need to get to bed. But they whine and they moan, and clearly they're getting in the way of your show. So you know what you do? You say, hey, look, these are not my kids anyway. You say, go to the freezer, take the ice cream upstairs, do whatever you want with it. You go back to watching your show. 10 o'clock, you arrive home. You notice the babysitter seems to be in a hurry to get away. So you give her the money. She's out of the door before you can even say goodbye. And then you hear the sound of thudding upstairs, kids banging off the walls. And that night you don't sleep. This is why you go out only once or twice a year. This is a classic agency problem. And there are two solutions to the agency problem. The first is to assume that anytime you hire a babysitter, you're going to have a sleepless night. Build it into your costs. The second is a monitoring solution. You know what that is? It's much more feasible now than 30 years ago. You set up cameras all over the house. You watch your babysitter while you're at the movies. You're watching on your phone. Oh my God, she's feeding them ice cream right now. Maybe you have some mechanism to send a signal to your house saying no ice cream. Something very similar happens with debt and equity. There are two solutions to the agency problem when you're a lender to a firm where equity investors have very different interests. The first is the monitoring solution. You hire legal, lawyers and other people to watch the company to make sure it's not taking risky projects, to make sure it's not paying dividends. You write in covenants and you have lawyers enforcing the covenants. That's one solution. You know what the other solution is? Assume the equity investors will take advantage of you and charge a much higher interest rate, saying, look, I know you're a safe company, but I know you're going to screw me over, so I'm going to charge you 5% more. One way or the other, guess who bears the cost? It's not the lender, it's always the borrower. No matter what you think you're pulling off as a borrower, it's always the borrower bears the cost. And the greater the agency problem, the bigger that cost. You're saying, why would there be different agency problems at different kinds of companies? Let me give you a very simple proposition. Let me give you 3 companies and think like a lender. Remember, you're lending money to these three companies, and I want you to answer a very simple question. In which of these three companies would you be most worried about what's happening with the money you lent out? And which of these three companies do you feel more secure for good reasons or bad? One is a technology firm, and it could be a software company, a hardware company, put whatever you want. The second is a large regulated utility. And the third is a real estate company. In which of these three companies would you be most worried as a lender about what these guys are doing with your money? Duanish, you want to try? Which of the three companies would be most worried?
The tech company,
And why?
because they probably have to return a much larger return for the equity investors to invest in them than the utility and the REIT.
Everybody's greedy though, right? Everybody tries for higher returns, but what is it about the technology company that makes you particularly uncomfortable?
Also, that their most of their growth is probably in the future. So
And the fact that what they invest in, you can't see. They claim to do R&D. You have no idea whether they do R&D. For all you know, they're pulling people off the streets, putting white clothes on them, say, wander around this glass building, act busy. You have no way of monitoring R&D. Their assets are all, you can't see them. It's one of the realities of the world that if you're a lender on things that you cannot see, you feel a lot more worried about than as a lender on things you can see. Now, do you see why real estate, even the real estate developers with the worst track records are still able to borrow money? Why? Because you have a building. For better or worse, as the banker, you drive around and say, that's the building my loan bought. This is a reality we cannot run away from. Companies whose value comes primarily from assets you cannot see, you can call them intangible assets if you want, have much bigger agency issues than companies that have physical assets, which means holding all else constant, you should expect companies with physical, tangible assets to borrow more money than companies which have the same earnings but whose assets are not physical. And with a regulated utility as a lender, you get an added bonus. Two added bonuses, actually. The first is because they're regulated monopolies, their revenues are pretty stable. It's not like the consumption of power in New York City goes up 30%, it drops 20%. In recessions, recoveries, you pretty much get pretty stable earnings. That's good. And the second restriction on regulated utilities is they can't go into other businesses. A regulated utility can't have a software business on the side. So you don't have to worry about what are these guys doing with my money? Are they taking risks that I don't even know about? If you get a chance, if you go to my website, I have debt ratios by industry. Just scan them down, scan down. You have steel, you have chemicals, you have software. See if it makes sense, because very quickly you're going to see this pattern emerge. Technology companies, even if they're old, mature technology companies like Apple, borrow a lot less than manufacturing companies or real estate companies of equivalent maturity. And if you can think about what company you're doing on your project, ask yourself, if I were lending to this company, how worried would I be about what's happening with my loans? So you're going to look at their history, you're going to look at their business. That's what the agency cost plays out in. Any question on the agency cost, David?
Yeah, quick question. So intangible assets are accounting for more of value of like the S&P 500. I think it's about 90%. So do you think that is going to go down in the future?
It is, if you think in terms of market cap based debts. If you look at the debt as a percentage of market cap, that's lower now for the S&P 500 than it used to be 20 years ago, 30 years ago. I know this goes against the conventional wisdom, which is US companies have been borrowing like crazy. But there's a subset of the S&P 500 where debt ratios have gone up, older, more mature manufacturing companies. But the nine of the top 10 companies, the S&P 500, are companies with intangible assets. It's the Facebooks, the FANG stocks, and none of them has a high debt ratio. I think Netflix might have the highest if you count their content commitments as debt, but it's like 15%. None of these companies have 50% debt, 60% debt, 80% debt. And some of them, like as you saw with Google, have 1.5% to 2% debt, which you would never see at a manufacturing company. Any other questions on, so we've got bankruptcy costs, agency costs. There's one final qualitative factor, which is, as I mentioned at the start of this discussion, I said, when you borrow money, you're using up the capacity to borrow the same money in the future, stating the obvious, but it's nice to have some debt capacity held back in case you need it. In case you need it for what? In case you get into trouble, in case a great project comes along, you're holding back that capacity. So I'm going to make a generic statement. I'm going to call this financial flexibility, the capacity to do something quickly because you have access to capital. Companies that value financial flexibility more will borrow less than companies that value financial flexibility less. You're saying, why would some companies value it more? If you're in a business where everything changes constantly, technology, even if you're a mature technology company, think of how quickly the world can shift under you. Yahoo was on top of the world in 2003, and 3 years later, it completely lost its footing. We've seen this happen before. So you're a technology company, might say, look, I can go out and borrow the money today, but everything can change in a couple of years. So I'm going to hold back the debt capacity just in case. So that is the basic trade-off that's going to drive how companies borrow. Those are interesting lists. You're saying, do CFOs actually think about all of these when they decide how much to borrow? So this is from a survey, and take it for what it's worth. Surveys, people can say whatever they want.
Professor,
Before I go there, go ahead, Hillary.
your slides aren't advancing. We're all seeing slide number 21.
Let's see what I can do here. I think that is almost entirely a function now against my internet.
It looks like
You
you're
could-
just sharing one monitor, maybe two. I'm not sure. Like there's a 1 in the top left corner.
Someone put the PDF in the notes though. So if you could just tell us what slide it's on if it doesn't work.
I'm on slide 24.
Professor, do you want one of us to share the slides and then just let us know when to advance them?
That would be great.
Okay.
I can take all the help I can take, but no. So I'm on slide 24, and
Okay.
then I'll have to tell you. But let's
If you maybe just try to reshare your screen, it might work.
There will be an agency cost of 5% extra credit.
there's a kind of contractual obligation here. Sorry about this. This hasn't happened all semester, but I was due for a shock sometime soon.
So yeah, we're not just looking at the slides either. It's like a piece of your desktop too. So that might be part of the problem.
You're on mute.
You're on mute.
Okay. I might need some. So if you can go to the PDF, I'll tell you which page I'm on. So if and if you don't want to look at your slides, you can catch up on it. After the class, just look at the audio and kind of keep going with the slides, because I've lost my PowerPoint file now completely. So
we are seeing a test expander. So.
Yeah, that's because I'm trying to get my PowerPoint open and it's refusing to open it. So. Now is the slide back on at least so you can see the, no, nothing?
Yes, we see slide 25. I mean 24 now.
Okay, let's see how long this goes. If the slides break down, I kind of remember what's on the slides. So I'm going to act like the slides are not even here and just talk. And then you can look at the slides and kind of catch up with the talking. But basically, I was talking about the trade-offs. So let's list them out. The pluses of debt are tax benefits and added discipline. The minuses are bankruptcy costs, agency costs, and a loss of flexibility. So in this survey, CFOs of companies were asked, when you go look at companies, when you look at whether to borrow money, do you factor these issues in? Which is kind of a good question to ask. So this is what CFOs said they weighed the most when they thought about whether to borrow money. The number one thing that they stated that they looked at was maintaining financial flexibility. It's pretty interesting, right? It's not survival, it's maintaining financial flexibility. The second they said is long-term survival. The third is they said, we want to borrow or use a capital that's a predictable source of funds. The middle came maximizing stock price, and then financial independence, ratings, and comparability to the peer group came at the very bottom. Now, we know people lie on surveys, so take this with a grain of salt. We know companies care a lot more about ratings than they let on, but at least in terms of when they're asked, they seem to claim that financial flexibility matters the most. So here's what I'd like to do. I'd like to list off the trade-off. Are you on page 25 now, or is it still on 24 for you?
It's
Okay, so
advancing.
25. So let's look at the trade-off. You've got tax benefits and added discipline. You've got expected bankruptcy costs, agency costs, and loss of flexibility. This is the trade-off no matter where you are in the world, no matter what company you're looking at, private or public. I'm going to take my companies, remember Disney, Vale, Tata Motors, and Baidu, and do a qualitative analysis of whether they're in a good position to borrow money. In other words, I'm going to take this trade-off and try it on my companies. Let's take each one. Let's start with tax benefits. What drives tax benefits? Your marginal tax rate. At least in 2013, the US companies I was looking at, which were Disney and Bookscape, had much higher tax rates than my other companies. Holding all else constant, I would expect those two companies to go out and borrow more money than the other companies in my group. In terms of added discipline, it turns out that Disney would benefit the most from added discipline. Why? Because it's the biggest company, most dispersed stock holding, most separation between managers and stockholders. So tax benefits and added discipline. So based on that, I would expect Disney to have the highest debt ratio of my 5 companies. Now let's go look at the cost. In terms of expected bankruptcy costs, Vale might be a mature company, but it's a commodity company. Iron ore prices go up and down. I worry about how much that might affect earnings. Disney should have the most stable earnings. It's a diversified entertainment company. And Baidu, because it's a young company, should have the greatest volatility in earnings. So holding all its constant, I expect Baidu to borrow the least, and again, Disney to borrow close to the most. In terms of agency costs, well, I think, if you look at the companies, Tata Motors, Disney and Vale all have physical assets you can lend at, though parts of Disney are intangible. But the risks of agency costs should be highest at Baidu. You lend to a search engine company, they claim to be investing your money. You have no way of monitoring what they do with your money. And finally, in terms of flexibility needs, Baidu should value flexibility the most because it's a young technology company. So if I looked at my 5 companies purely in terms of my trade-offs, I would expect Disney to have a fair amount of debt and Baidu to have very little debt. In a minute, I would show you what their actual debt ratios look like, and we can see if it makes sense. But that is basically how the qualitative trade-off works. And I'd like you to try this on your company. Just in purely subjective terms, look at your company's tax rate, look at, how much you think the company might benefit from having debt and making it more disciplined. Is it a founder-run company or is it a management-run company? And then look at the bankruptcy costs, the agency costs, and loss of flexibility. I know it's not going to give you a number. It's not going to say 30% debt, 40%, but it'll at least tell you my company should not be the kind of company that borrows money, or my company should be the kind of company that should be borrowing money. So when you look at your company, just make that assessment. Start with that assessment. We'll talk about tools that will make that assessment more specific, where you can go beyond, hey, you should borrow a lot of money to 40% debt or 60% debt. But that judgment is where you start your analysis of whether your company is borrowing too much or too little. So here's what I'd like to do. I'm going to put you in a hypothetical scenario. Think of this as a Twilight Zone episode, one of my favorite shows. You wake up and you're in a world where this is true. There are no taxes. You say, I'd like to stay in this world. You're welcome to stay here. So you're in a world with no taxes. Managers act with the stockholders' best interest. So basically, they pick good projects, they reject bad projects. They're not lazy, they're not sloppy, they don't have self-interest. No company in this world ever goes bankrupt. Equity investors, when they go out to borrow money from bankers, are honest and upfront about the risks, and they say what they'll do and they do what they say. And finally, companies know their future financing needs with certainty. Now, here's what I'd like you to do. Go back to the trade-off that we had and think about what will happen in that trade-off in this world, right? Let's start at the top. What happens to tax benefits? They go to zero, right? No taxes. What about added discipline? If managers are already acting in stockholders' best interest, who needs that? Zero. Expected bankruptcy costs? Zero. Nobody ever goes bankrupt. Agency costs, since equity investors never lie and they act according to their words, zero. And if you know your future financing needs with certainty, who needs flexibility? So you have zero benefits, zero costs. So Jeremy, in this world, how much should a company borrow? If you have no benefits and no costs. I can't hear you, Jeremy.
Sorry.
Yeah.
None if there's no benefit and there's no cost.
Or 100 million, or $1 billion, or 2 billion, or 10 billion. In other words, it doesn't matter how much you borrow.
Right.
Everybody
but if there's
with me
no
so far?
benefit and no cost, I would guess no cost also means no headache at all.
No
Like
headache,
it's not worth
nothing.
any effort though.
It's
if there's
not
no
any
benefit.
effort. So basically, you might as well borrow. Joe?
Yeah, I mean, I was just wondering why you wouldn't borrow up to the point where you're minimizing your weighted average capital.
Now, in
cost of
this
capital.
world, you know what your cost of capital will look like? The same at every debt ratio. It'll be exactly the same, whatever you gain. So that's the thing, your cost of capital stays fixed at every debt ratio, your value stays the same, so there is no optimal. If you're with me intuitively on that, in this twilight zone, I know it's a very unusual world because I've created a world with no taxes, no default risk, no agency costs. Congratulations, you've just derived corporate finance's most famous theorem. It's called the Miller Modigliani theorem. The Miller Modigliani theorem says it doesn't matter how much you borrow because there are no costs and no benefits. In a world with no taxes, no default risk, and no agency costs. And in the Miller Modigliani world, your cost of capital, if you look at the bottom of the page, hopefully you're on page 28 or wherever we are, stays constant. So whatever you gain by using more cheaper debt with more expensive equity, you exactly offset. So you end up with a constant cost of capital. Miller and Franco Modigliani won the Nobel Prize for the Miller Modigliani theorem. And the tragedy of the Miller Modigliani theorem is there have been generations of MBAs who've gone through capital structure classes, and you ask them, what's the only thing you remember from your capital structure classes? Guess what it is? It's a Miller Modigliani theorem. How convenient. You're saying, I don't remember any of it, but it doesn't matter anyway. You'd be amazed at how many bankers I run into who use the Miller Modigliani theorem every time you talk about debt, like garlic with a vampire. You bring up the issue of debt, Miller Modigliani, back off, Miller Modigliani, stop the conversation now. They seem to have forgotten what the Miller Modigliani theorem assumed about taxes and default risk and agency costs to get to that conclusion. In fact, in the early 90s, I remember running into a a student of mine who graduated in my, I think the very first class I taught at Stern at NYU then, 1986 he graduated, went to work for an LBO outfit, was involved in the ill-fated Federated Bloomingdale's LBO in the late 80s, which blew up and took the firm down with it. His firm went bankrupt, but he managed to switch jobs. He was somewhere else. I asked him, what have you been doing? And he said, I used to work for this LBO outfit on the Federated deal. And I said, that's very interesting. And I said, I've always wondered why you took on so much debt to buy a company like Bloomingdale's, which is this specialty, it's a luxury retailer. It's going to go up and down with the economy. It doesn't look like the kind of company we want to go to 90% debt. You know what his answer was? Remember the Miller Modigliani theorem? And I said, I do. He said, didn't they say it doesn't matter how much you borrow? I said, I'm glad you live in a world with no taxes, no default risk, and no agency costs, but remind me again what happened to the outfit you used to work for. And without a trace of irony, he said they went bankrupt. You see the irony here? He's talking about the Miller Modigliani theorem, and in the same breath, he's talking about his company going bankrupt, which directly violates one of the first assumptions. In fact, this is Miller Modigliani 1. They did a second paper where they relaxed only one assumption. They said, what if we put taxes into this Twilight Zone world and left everything else as is? So you have taxes, but no default risk, no bankruptcy costs, no agency costs. What's going to happen to the optimal mix of debt and equity in that world? I've given you the upside of debt, and I still kept out the downside. Guess what every company should be at in that Miller Modigliani 2? Every company should be at 100% debt, because if I give you the pluses of debt and none of the costs, if you give companies tax benefits for borrowing and you keep bailing them out every time they get into trouble, guess what? They're going to be at 85, 90, 95% debt because you've given them the upside and none of the downside. Miller and Modigliani did not get the Nobel Prize for the conclusion of the theorem, which is it doesn't matter how much you borrow, because that's an absurd one. They got the Nobel Prize for setting up the structure for thinking about the right mix of debt and equity, because we still use Miller Modigliani as the basis for our discussion, but we live in a world with taxes, default risk, and agency costs. And in that world, you can very quickly see you can borrow too much. I'm stating the obvious. You can borrow too much, or you can borrow too little. There is a right mix of debt and equity, but to arrive at that conclusion, you have to walk away from those limiting assumptions of no taxes, no default risk, no agency costs. Any questions on the Miller Modigliani theorem? So I could algebraically prove the Miller Modigliani theorem for you, but why bother? Intuitively, you can see what's going on, right? If you have no taxes, no default risk, no agency costs, you have no pluses and no minuses to borrowing. It doesn't matter how much you borrow. So I'm going to do a little tangent here. Before we look at the right mix of debt and equity for your company, I want to look at what companies actually do. When companies go out to raise capital, there are two things that managers seem to value a great deal. The first is, as you saw, financial flexibility. Managers like flexibility. They like to be able to raise capital which comes without strings attached, without restrictions. And the second is managers value control. And those two forces might be in conflict with each other. So you value flexibility and you value control. So let's say you're the manager at a publicly traded company. You value flexibility. So you want to raise capital and not have to answer questions. And you want control, where basically you decide where the money goes. And again, there's no filings to make. You don't have to tell people what to do. What is your best way of funding a project? If you're a manager at a publicly traded company, you value flexibility and you value control, what is the source of financing that comes with the least strings attached and over which you have the most control?
Issue stock.
I'm sorry, what?
Issue stock.
Well, if you issue stock, you got to file a registration statement. If you file a registration statement, you got to tell the world what you plan to do with the money, right? I mean, there's a whole bunch of strings attached, and then you got to go through a market process. to raise the capital. So issuing stock is actually pretty messy in terms of how much you got to let the world know. David?
Your retained earnings.
Retained earnings, right? If you make money as a company and you use it, you don't answer to anybody. Your shareholders might say, why don't you pay more in dividends? But remember, they're not contractually entitled to those dividends. Your number one way of funding projects will be retained earnings. Most flexibility, absolute control. You know what the second best way of raising money is going to be? It's not issuing stock. It's actually borrowing money. It's easier to deal with a banker and borrow money. The constraints that come with it, the restrictions are actually fewer than when you go out and raise equity. And then you get to hybrids and special kinds of securities. In fact, this is called the financing hierarchy. Basically, when you look at what companies use to fund projects, and you can get this both from surveys and actual numbers, the number one way, if companies have their choice of funding projects, is retained earnings. Right below it is just conventional debt. You called it straight debt, but to the extent that you might think that has sexual connotations about the debt, it's just conventional debt. So basically no strings attached. It's, interest rate is set, finite period. Then you get convertible debt, where the debt can become equity at some point in time. Then comes Sharon's point about new stock issues, number 4 on the list. And then comes preferred stock, and then convertible preferred stock. And when you look at the actual numbers, you back this up. This is actually a graph for US companies of how much of their funding each year comes from retained earnings. That's what internal financing is. That's the red part of the graph. How much comes from new stock issues? That's the blue part. And how much comes from new bond issues? Notice how little money is raised from new stock issuances by established companies. Once a company goes public, coming back to the market to raise equity is uncommon. It's not ruled out. Clearly, GameStop is doing it right now, right? But there's a reason GameStop is going out and raising. Why is GameStop raising all this money? Because the stock price has gone through the roof. They're trying to cash in. In fact, somebody asked me on an interview yesterday what I thought about GameStop. And I said, GameStop is playing a very interesting game. That's play on words. They're trying to create a SPAC in the company. Because if you think about it, that's what they're doing, right? You're giving them money and you don't have any idea they don't have any idea what they're going to do with the money. And I'm not sure you want to trust these guys with your money, but I guess people are willing to. Once a company goes public, it is uncommon for that company to come back to the market to raise fresh equity. In fact, when you see share issuances after a company goes public, these are called seasoned issuances. They usually happen in the context of acquisitions, where you give. So when Disney made a share issuance, it was to buy Pixar. It gave Steve Jobs all those shares in return. But issuing shares to actually raise capital is very, very unusual. So here's a very simple test. Let's suppose you open up the Wall Street Journal. You know what a tombstone ad is? This is where a company says it's going to raise money and it tells the world, this is the kind of security we're going to use. So you're reading this ad, a tombstone ad for a company. You've never heard of the company. But the company says it's issuing convertible preferred stock to raise capital. That's all you know. So the only thing, the company name, and you've never heard of the company, and it tells you what kind of security it's issuing. I'm going to ask you a question. It's going to sound like an absurd question because I'm not going to let you go check Yahoo Finance or the financial statements. And based on this tombstone ad, if I asked you whether this was a healthy company or a troubled company, would you be able to answer the question? Gil, what do you think? Healthy company or troubled company, based on the fact that they're issuing convertible preferred. And you can turn back 2 pages if you want and look at the financing hierarchy and see if it matters. I'll turn back because it might be more. This is the financing hierarchy. What are they using? Convertible preferred. If you're going to the bottom of the barrel to raise capital, what does it tell you about a company? Healthy companies don't issue convertible preferred. Are there exceptions? Maybe. But if you're telling me you're issuing convertible preferred, I'm going to say, how close to the edge are you? Because this is the ultimate admission of nothing else is going to work for me. When you see companies going towards the bottom of this financing hierarchy, they're telling you stuff about themselves that you, if you don't watch, you're going to do it at your own risk. So that's basically what companies do. They use retained earnings as their primary way of equity reinvestment. And if they get desperate, they might issue new stock. And if they get really, really desperate, they might issue convertible preferred. But it's a measure of the healthiness of the company in terms of how far down the barrel or deep into the barrel you want to go to come up with your financing. Any questions? So let's now talk about the right mix of debt and equity, the optimal mix of debt and equity. Are my slides still staying afloat, or so you're on page 35 with me? So we're going to go back to the optimal mix. What we've looked at is a qualitative trade-off. What are the pluses? What are the minuses? I want to talk about more specific ways where I can come and say, what is the right mix of debt and equity for you, and give you a number, 30%, 40%, 60%. And I'm going to lay out 5 different approaches. The 5th I've kind of talked about already, the life cycle approach, but here are the other 4 that we'll go through. The first is what I call the cost of capital approach. Remember, we computed the cost of capital in the context of investment analysis. There it was a hurdle rate, something you needed to make for a project to be a good project. I'm going to use that approach to also tell you what the right mix of debt and equity is. Along the way, I'm going to list out some assumptions, some of which are pretty rigid for this approach to work. And then I'm going to relax those assumptions and offer you a second approach, which I'll call an enhanced cost of capital approach. It's a cost of capital approach with some bells and whistles added. The third approach is called the APV approach, the adjusted present value approach. It's an approach that was developed in the University of Chicago. In fact, if you go for a Chicago MBA, you'd be told the APV approach is the only way to come up with the right mix. It's a true way. I think the way it's practiced is so absurdly sloppy that I don't buy into that. I'll talk about the APV approach and how to do it right. And you're already going to see why most people who claim to use the APV approach are really just being incredibly sloppy. And then I'm going to talk about the approach that most companies use. You know how most companies decide how much to borrow? They look at everybody else in their sector, they look at what they're doing, and they try to do something similar. So if you're an airline, why do you have a lot of debt? It's because everybody else has a lot of debt. If you're a technology company, why don't you borrow money? Because nobody else borrows money. You're saying that is absurd. Me Tooism is really a strong force in corporate finance. But that's what the sector approach does. It looks at the sector and says, what is everybody else doing? And try to stay as close as you can to that norm. So let's start with the cost of capital approach. Very quickly reviewing, cost of capital is a weighted average of your cost of equity and your cost of debt. And in the context of investment analysis, we said it's your hurdle rate, right? It's what you need to make on projects to break even. So when you did the Google G-Car, the cost of capital became your hurdle rate. But there's another use for the cost of capital, which you're going to see towards the end of this class. But if you're in the valuation class, as some of you are, it becomes the discount rate I use to value an entire company. So the same cost of capital that we use as a hurdle rate in investment analysis becomes the discount rate I use to value Disney as a company. So let me make a very simple statement about the value of a company. The value of a company is the present value, the cash flows that you're going to get at the company discounted back at the cost of capital. Let's play a game. Let's assume I can keep those cash flows fixed. Remember, those are pre-debt cash flows, so those cash flows stay fixed. What happens if I lower my discount rate with the same cash flows? What happens to my present value? So it goes up, right? And if I minimize my cost of capital, let's say I find a way to minimize it. What have I done? I've maximized the value of my firm. Does that sound familiar? That is my end game in corporate finance. Remember, everything we do in corporate finance is about maximizing value. And if I buy into that objective, one way to get there is to minimize my cost of capital. So here's what we're going to do. We're going to change the debt ratio and try to find the debt ratio at which the cost of capital is lowest. And then we're going to say that's our optimal debt ratio. Why? Because at that debt ratio, my firm value is highest. So let's start with a very simplistic example of why this might be a little more messy than it looks. Okay, so that's easy, just change the debt ratios. Here's why it gets messy. I'm changing the debt ratio, the weight of debt, right? So I go from 0% debt, 10% debt, 20% debt. As the debt ratio changes, everything in my cost of capital will also change. Let me explain. As my debt ratio changes, my cost of equity will change. Why? Because my cost of equity comes from a beta. The beta is a levered beta. And if I borrow more money, the levered beta goes up, my cost of equity goes up. As my debt ratio changes, my cost of debt will change. Why? Because the bank is getting more scared. If I have 30% debt rather than 10%, my cost of debt goes up. In fact, if I'm not careful and I've borrowed too much, I might even start to lose my tax advantages, right? I have too much in interest expenses. Even my tax rate could change. You can't just change the weights. Everything in your calculation has to change as your debt ratio changes. It sounds more complex than it has to be. I'm going to do this for Disney, but I'm setting the table. My job is to assess the cost of capital at every debt ratio, which means I've got to come up with the cost of equity and a cost of debt at every single debt ratio. Now, before I do that, though, I'm going to go back to something we talked about when we talked about the cost of equity very early in this class. And this is actually an actual conversation or in an article in an Asian business magazine, but the CFO of a very large Asian company argued that equity was cheaper than debt. He was a completely equity funded company, and the reporter asked, how come you don't borrow money? And he said, equity is cheaper than debt. And his statement was based on the fact that the dividend yield he was paying on stock was much lower than the interest rate he paid on his debt. If you define the dividend yield as your cost of equity, what's Google's cost of equity? It doesn't pay a dividend. It's zero. It's absurd, right? But it shows you how much CFOs think in terms of dividends versus interest as costs, instead of thinking of equity as, say, it's not just the dividend, it's the price appreciation part. In fact, let me ask you a follow-up question. Can equity ever be cheaper than debt for a company? Keep this question in your back pocket, because in a few years, you're going to be the interviewer rather than the interviewed. This is a great interview question because it's not as easy as it sounds. Because the first side, what do you say? Oh, equity can never be cheaper than debt. Debt is always the first guy in line. I'm always the last guy in line. If he's charging 5%, why would I accept less than 5%? I'll give you the exception. 95% of the time, equity will always be more expensive than debt. Why? Because you're in the back of the line. The debt guy is in front. I'll give you the 5%. Or actually, I'll set up the process, and you can tell me that where that 5% will show up. What drives the cost of debt? Default risk, right? Bankers don't sit there doing a beta calculation. They say, what's the default? So cost of debt is driven by default risk. If you're a publicly traded company with diversified investors, and I'm setting the table right here, what drives your cost of equity? Your beta, right? And what drives beta? It's the amount of market risk exposure you have as a company. Do you see where the exceptions to the general rule can come? What kinds of companies have really low betas? Think about the unlevered beta for a company coming from the business it's in. What kinds of companies have really, really low betas? In fact, I showed you a picture of high beta to low beta, and I told stories. What was at the very bottom of the list? Very low beta businesses. Think gold mining companies, companies that are insured. So if you're a gold mining company, your beta will be this really small number. Why? Because even though you have a lot of variance in your earnings, most of it has nothing to do with the market. Equity investors in this company might settle for a 4% return. But remember, a bank lending to a gold mining company still faces all the upside and downside of gold prices going up and down. So it can happen. For some companies, the cost of debt is higher than the cost of equity. But as a general rule, you should expect to see the cost of equity be higher than the cost of debt for most companies. Any questions on the process? So I'm going to start with a hypothetical example. This is actually an example that I've saved for, trying to think of how long it's been, 42 years. This is my first corporate finance class. I was sitting in a class in UCLA in 1979. My corporate finance professor walked in and he said, today we're going to talk about the optimal mix of debt and equity for a company. And we're going to use XYZ widget company. What's this with widgets? I've never understood this fixation with widgets. I guess if you pick a widget company, you have no idea if it's something you need, something you don't need. You can make up crap as you go along. So already he set the table saying, I'm going to make up a company. And then he said, I'm going to show you a table to show what the optimal mix of debt and equity is. And in the table, your debt ratio is going from 0% to 100%. I didn't know better, but already there's a flaw in this table. Can the debt ratio ever be 100%? In a going concern, think about it. What's equity? It's whatever the residual risk is. If nobody's bearing the residual risk, guess what? Everybody's at 100% debt. It's almost like everything is equity because there's nobody bearing the residual risk. But we could cut him some slack. Maybe it's 99%, a really high debt ratio, from 0 to 99%. And then he gave the numbers for cost of equity and cost of debt. And I'll tell you exactly what he told the class when he put up these numbers. He said, as the debt ratio goes up, the cost of equity will go up. And he told us a story that made sense. He says, equity in a more debt-laden company is going to be riskier. You'll demand a higher cost of equity, which makes sense, right? But then some guy in the front row, wasn't me, put up his hand and said, but why is it going up the way it is? You see why it was a little suspicious? The cost of equity went up 0.5%, then 0.6%, then 0.7%. To be quite honest, it looks like he's made up these numbers. He said, well, the details don't matter as long as you get the concept. Let's move to the cost of debt. He very quickly skipped to the cost. Then he told a story. He said, as my debt ratio goes up, my cost of debt will also go up. Why? He said, well, the lender gets more scared. But he told the story. And again, the same guy in the front row put up his hand, but why is it going up the way it is? And he said, just take the details. You don't need the insights. The cost of debt will go up. He multiplied the cost of debt to get an after-tax cost of debt. And the cost of capital is just a weighted average. And he computed the cost of capital. And he said the optimal debt ratio for this company is the one that minimizes the cost of capital. You look at the second to last column, that's 10.14%. And the optimal debt ratio is 40%. He even put an icing on the cake by showing you what the value of the company would be at a lower debt ratio, because keeping the cash flows fixed, a lower cost of capital gives a higher value. And he was ready to move on when he realized the class wasn't moving along with him. In fact, he decided that we were so dim-witted that we weren't getting the obvious. He said, let me show it to you in a different way. And he showed a graph. And he said, now do you see what the optimal debt ratio is wherever the cost of capital is lowest? He was missing the point. Our issue was not with what he was doing, but how do you get a table like this for a real company? You just made up a company, you just made up numbers, you have the whole table, anybody can compute the optimal debt ratio. But when you walk into a real company, think about the company you're doing right now. If I asked you, can you show me the table of cost of capital for your company? Your answer is, if you're keeping up with the project, is I can tell you what the cost of capital is right now at their existing debt ratio. I don't have a table, I have a point. This is the challenge you face in corporate finance, is nobody gives you this table. But that's the way every corporate finance textbook at that time was written, with this U-shaped graph and this hypothetical company, and said, trust us, if you can find this graph, you can find the optimal. And my question always was, how the heck am I going to get this graph for a real company? So what you're going to see me do with Disney was my attempt in the late 80s to actually try to make this practical. You might not like some of the shortcuts I have to take, some of the assumptions I have to make, but by hook or by crook, I'm going to create a table like this for Disney that actually will allow me to use it on a real company. So let me take you on a journey of trying to compute the optimal debt ratio for Disney. Remember, my objective here is to come up with a cost of capital at every conceivable debt ratio, right? But before I get too ambitious, might as well get that one point that I know nailed down, which is, what is their existing cost of capital? And if this page looks even remotely familiar, it's a page that you saw 100 pages ago in the context of investment analysis. I took that bottom-up beta. Remember, by looking at the 5 businesses, I came up with a bottom-up beta for Disney. I used the T-bond rate and the equity risk premium to come up with a cost of equity of 8.52%. That is my cost of equity for Disney with a bottom-up beta and an equity risk premium that reflects where they do business. The cost of debt reflects their actual rating, single A, spread of 1%, so that's 3.75% pre-tax, times 1 minus my marginal tax rate, which for Disney in 2013 was about 36%. My cost of debt after taxes is 2.4%. And based on the market values, and remember, cost of capital is always a market value based number. This company is about 88% equity, 12% debt, have a cost of capital of 7.81%. Right now, Disney has 12% debt ratio and a 7.81% cost of capital. Let me frame the question I'm trying to answer. Is there a better mix of debt and equity for Disney? What does a better mix mean? A mix that gives me a cost of capital lower than 7.81%. That's really the challenge that we're facing here, is how do we come up with a cost of capital, not at the existing debt ratio, but every other debt ratio. So let's think about what we need to do this. I know my existing cost of equity. I know my existing cost of debt. I know the debt ratio right now. To get my cost of capital at every other debt ratio, the first thing I need is a cost of equity at every debt ratio. And this one, because of the way I've estimated betas, is pretty straightforward. Because the way I estimated betas is I start with an unlevered beta and levered it. So if you now give me a different debt to equity ratio, I can tell you what the beta will be at 10% debt, 20% debt, 30% debt, 40% debt, 99% debt. That's the advantage, again, of abandoning regression betas and building up to a levered betas. You can tell me what the beta will be at every conceivable debt ratio. So the cost of equity is actually going to be pretty straightforward. The levered beta will go up, the cost of equity will go up. The cost of debt is going to be trickier. Remind me again how I got the cost of debt for Disney right now. I look up their existing rating, right? So initially, here's what I tried. I had a student of mine who was working at S&P, and I sent him a table, and I said, I can see a rating at the existing debt ratio single A. Can you fill in the ratings you would give Disney at every debt ratio? That'll make my life a lot simpler, right? If S&P filled this out and sent it to me. He sent it back to me with my number and said, if you do it, then I will tell you. In other words, S&P is not in the business of telegraphing what your rating will be at all these hypothetical debt ratios. That's not our job. So I had to be my own ratings agency. And again, the way I've approached this, the way we did cost of capital, it's not that difficult, right? How did I get a rating for a company with, or how did I get a cost of debt for a company which didn't have a rating? I computed a synthetic rating. Does anybody remember how I computed that synthetic rating? William, do you remember how we computed synthetic ratings for companies?
No, I'm trying to remember. Did it have to do with
It was one ratio.
what was it, that interest coverage ratio?
You got it, right? And what's the interest coverage ratio? It's operating income in the numerator, interest expense in the denominator, right? Here's what I'm going to do. As you borrow money, I'm going to compute what your interest expense is going to be at the new debt. And guess what? If you have more debt, you'll have more interest expense. And if you have more interest expense, your coverage ratio is going to get lower. I'm going to go to that lookup table I used to get the rating and say, this is what your rating will be at 20% debt, 30% debt, 40% debt, 50%. And when I'm done, I'm going to be able to give you a rating at every debt ratio, not just at today's debt ratio. That's it. You're home free. Your cost of equity is going to come from a levered beta. Your cost of debt at every debt ratio is going to come from a synthetic rating. I'm going to be able to do exactly what my professor did with that XYZ widget company. So let's do the easy half first. Let's do the beta at every debt ratio. And by now you can see things start to build on previous things. In this case, what I'm going to do is I'm going to go back to the unlevered beta that I got for Disney based on the businesses they're in. Remember the 5 businesses, I got the beta of each business. The unlevered beta I got for Disney based on the businesses they were in was 0.92. That's my unlevered beta. I could have used a regression beta if I were lazy, but remember what we said about regression betas. Why mess with them? Why even use them? Sushant?
I want to ask, when you're talking about like debt, the interest coverage ratio and cost of debt, wouldn't you would not be incorporating like the business model or like how risky the business is in that calculation?
Not in the interest coverage ratio. You're saying for a given operating income, don't I care about how volatile the operating income is? You're absolutely right. Maybe we need 3 separate tables, lookup tables. One for companies with unstable operating income, one for companies with regular operating income, and one for companies with really stable operating income. So your point is a good one, which is as a lender, not only do I care about how much money you made last year, but how much variance there is. But that's just an extension of a lookup model, right? You just have 3 lookup models or 5 lookup models, but ultimately you're still doing the same thing, attaching a synthetic rating to the company. So I'm going to take this unlevered beta. And I'm also going to bring in the other information you need to do your ratings, which is you need to know how much money Disney made. And in 2013, their operating income was about $10 billion. And to Sushant's point, if you really wanted to do this right, you'd like to know what the operating income was in 2006, 2007, 2008, 2009, 2010 to make sure you're not coming up with an optimal debt ratio based on a very strange year. So you're okay replacing last year's number with an average over the last 5 years if you felt that's a more reliable measure of what the company can make in the future. So the unlevered beta and the financials for the company is where I start my journey. Then I do the easy half of my table. By now, you should be able to unlever and relever betas. You've done this in the context of the first quiz, the second quiz, and even if you've forgotten the equation, you take the unlevered beta, you come up with a debt to equity ratio, and you come up with a levered beta. And as my debt ratio goes up, my levered beta will always go up. There are no exceptions. My cost of equity will always be higher at a higher debt ratio than at a lower debt ratio. Intuitively, that's because as an equity investor in a company with a lot more debt, you face more volatile earnings. So notice my cost of equity for Disney will go from 8% when they have no debt to 39% when they have 90% debt. Incidentally, when they have no debt, my cost of equity is also my cost of capital, right? Because if no debt, the cost of equity is 100%. But basically, you can see the cost of equity will always increase as my debt ratio increases. That's why companies that say that their objective in the financing mix is to minimize their cost of equity. If that's your objective, you know what you should have? Absolutely no debt. That's where your cost of equity will be minimized. Any questions on the cost of equity half? So this is basically something you can do for any company. Once you get the unlevered beta, change the debt to equity ratio, you can have a cost of equity at any conceivable debt ratio. Now let me turn to the cost of debt, because there's a component to the cost of debt which is tricky. And I'm going to describe the process I'm going to use. There's a flaw in this process. Let's see if you can spot the flaw. So you asked me what the cost of debt will be at 10% debt. I'm going to go through the steps. And as I said, in one of these steps, there's a flaw that you will notice. Let's see if you notice which step. So let's say I'm going from 0 debt to 10% debt. The first thing I need to do is take the value of equity and debt that they have around. So that's the market value of equity, that's the market value of debt. Add it up. My total enterprise value for Disney as a company is about $138 billion. So that's what my total company is right now. You're saying, why do you need that? When I go to a 10% debt ratio, remember these are all in market value terms, the first thing I need to figure out is how much debt I will have. 10% of 137,839 is 13,784 million. So that's the first step, is estimating how much dollar debt you will have at 10% debt. Everybody with me so far? My EBITDA and DA remain the same when I go from 0 to 10% debt. And here there's actually an implicit assumption I'm making that I want to make explicit. You're saying, if you're going out and borrowing $13.78 billion, how come you're not taking more projects? How come your operating income is not changing? That's because I'm doing what's called a recapitalization. What do you do in a recapitalization? When you borrow money, you know where it goes? It goes to either pay a dividend or buy back stock. So what comes in through one door leaves through another. So basically, the company remains the same. All I'm doing is changing the mix of debt and equity in the company. So my EBITDA and DA remain what they were because it's the same company, same theme park, same movies, same broadcasting shows. So EBITDA is 12.5 billion, DAR is 2.485 billion. My EBIT is 10 billion. That remains the same as well. And then I compute an interest expense by taking the dollar debt and multiplying it by the interest rate I will have at a 10% debt ratio. I get an interest expense of 434 million. Remember, your job is to spot where I'm running into this flaw in my reasoning. So I've taken the dollar debt multiplied by the interest rate, I get an interest expense. I divide the operating income by the interest expense, I get an interest coverage ratio of 23. If we go to the next page, this is my ratings lookup page that we saw earlier in the class. At a 23 interest coverage ratio, my rating is AAA. The rating of AAA, my cost of debt is 3.15%. So let me go through the steps and you tell me where the flaw is. I start with the dollar debt. I multiplied the dollar debt by the interest rate to get an interest expense. I divided the operating income by the interest expense to get an interest coverage ratio. I used the interest coverage ratio to come up with the rating, and I used the rating to come up with an interest rate. Kushal, where in that 5-step process is my flaw?
This is a guess, but we're using the current cost of debt to come up with the interest expense, which then drives.
In other words, you got it nailed down. To get the interest expense, what do I need? I need the interest rate. To get the interest rate, what do I need? I need the interest expense. This is like a chicken and the egg problem, right? To get one, I need the other, but to get the other, I need the first. I don't have the solution to the chicken and the egg problem. I don't know which came first. I don't want to go there. But in this one, I have a solution. It requires actually, and I'm going to take you through the process, and I'm going to use the 30% debt ratio to kind of illustrate what this process is. Okay? So I'm going to do with the 30% debt ratio what I did at 10%. You're going to see this process play out. So here's what I did. I start with the 30% debt ratio. At a 30% debt ratio, my debt to equity is 30 over 70. So, because we have 30% debt, you have 70% equity. The dollar debt at a 30% debt ratio is 30% of 137,784. Basically, the dollar debt is 41,352. So that 13,784 million is an increment every 10%. EBITDA, EBIT remained the same. So that was easy. The first time around when I do this, so think of the last 3 cells as not known. They're blank yet. I take the interest rate from the previous level of debt, which is what Kushal mentioned, because I know what it was at 20%. I know it's completely unrealistic that a banker will lend me this extra 13.78 at the old interest rate, but I act like I was able to borrow it. My interest expense with a 3.15% cost of debt is 1.3 billion. Interest coverage ratio is 7.7 based on that. I go to the previous page. 7.7 gives me a rating of AA, which gives me a cost of debt of 3.45%. And if I stopped right there, if I didn't have this next column, do you see the inherent contradiction what I've done? I've computed an interest expense based on an interest rate of 3.15%, but at the end of the process, I'm saying, you know what? Your true interest rate is going to be 3.45%. You can't have both rates coexisting in the same calculation. That's why I have the second column. So here's what I do. I recompute the interest expense at my new interest rate, which I now have because I've done the interest coverage ratio. I get a much higher interest expense, a much lower interest coverage ratio. Then I very gingerly turn back to the previous page, hoping and praying what hasn't happened, that I haven't slipped another notch. Because remember, each time the interest coverage ratio decreased. In this case, I got lucky. I stay in the same AA rating. I'm done. My cost of debt now matches up. I can go to the 40% debt ratio, the 50% debt ratio, the 60% debt ratio. But basically what I'm doing with every debt ratio is starting the process using the debt ratio from the previous level, but checking the interest rate to make sure that it's not inconsistent. If it is, doing a second or a third iteration to get there. The good news is I've never had to do more than 3 before I get convergence between the interest rate I'm using and the interest rate I'm giving the company. But you can see this process play out across the debt ratios. The first time I did this with a calculator and I did each column. It took about an hour to do, but if you're doing a $50 billion company, I don't care how much you value your time, spending an hour to come up with the cost of debt at every debt ratio doesn't sound like a lot of time to spend. But I'm going to give you an Excel spreadsheet that will do this for you But it's basically set up. So when you open the spreadsheet, some of you might get this warning that there's circular reasoning. Don't try to fix it. It's a feature, not a bug. What you need to do is go into the Excel preferences and check off that calculation, the iteration option. There's an option, and I'll show you how to do it. It'll basically, the spreadsheet is doing these iterations so you get that convergence. But don't get caught in the weeds. I mean, this iteration process is just a way of trying to come up with a rating and a cost of debt at every debt ratio. So here's what the end game looks like. Assume I've done this at 30, 40, 50% debt. I have the interest coverage ratio at every debt ratio. And as my debt ratio goes up, my coverage ratio decreases. Make sense to you? More debt, more interest expense, lower coverage ratio. As my coverage ratio decreases, my ratings go from AAA down to single C. These are my final ratings. I did the iterative process. You're saying Disney is a single C rated company? You can take any company, no matter how amazing it looks, and make it a single C rated company if you borrow enough money. If Apple borrows $1.5 trillion, trust me, they will be a single C rated company or be in default. My tax rate is 36%. That's my marginal tax rate. But something seems to happen at 70% debt. It's almost magical. My tax rate seems to get lower. First, is this a good thing or a bad thing in the context of cost of debt to have a lower tax rate? What does a lower tax rate do? It pushes up my after-tax cost of debt, right? So when I have a lower tax rate, I'm saying you're getting fewer tax benefits. So what do you think is happening at the 70% debt ratio that's leading you to lose tax benefits? Sarah, do you want to try? Let me help you along. To get your tax benefits, what needs to be true? What has to be true about your operating income and your interest expense?
That you're operating at a loss.
Okay, you're operating at a loss, which means your operating income is less than your interest expense, right? So you know what's happening at 70%? At 70%, my interest expense actually becomes larger than my operating income. And I say, oops, I can't get the tax benefit anymore. I'm going to cap it at my 10,032 million, which is my EBIT, because beyond that, I get no tax benefits. So at 70, 80, and 90%, my interest expense gets so large that I've given up on my tax benefits. You're saying, can't you carry losses forward? I mean, this is not a temporary problem. You go out and take a 90% debt ratio, you're going to be stuck with this for years in the future. So I'm adjusting your tax rate for the fact that you don't have enough operating income to cover the interest expense. So my cost of equity comes from my levered beta. My cost of debt comes from the synthetic rating and the adjusted tax rate. Remember, I promised you that you'd see a table for Disney that looked like XYZ widget company? Here's my table for Disney. But every number in this table, if you point to say, why is my cost of equity 10.34% at 40%? I can give you an answer. It's because my unlevered beta is 0.92. I've got a debt to equity ratio of 66%. My levered, so every number here comes from either a beta or a synthetic rating. But here's the bottom line. If you look at the cost of capital, the optimal debt ratio for Disney looks like it's about 40%. It's a little unfortunate that we've had two examples in a row with a 40% optimal. I still remember I was doing this at, I don't know, Bankers Trust maybe 30 years ago, and I had these two examples, and banker in the back row puts up his hand. He says, can we safely assume that the optimal debt ratio for all companies is 40%? Always looking for an easy rule, right? If it's always 40%, why do we go through the analysis? I'll go tell my clients 40% is the right debt ratio. I thought he was joking there. It's amazing how people have these rules of thumb. Isn't the optimal always 30%? Is it 40%? The answer is it could be 10%, it could be 90%. You're going to see this when you do this on your company. For some of your companies, the optimal debt ratio is actually going to be 0%. Be ready for that. Because as you add debt, even getting to 10% debt, the costs overwhelm you. Usually young growth companies with huge market caps. At the other extreme, there'll at least be 2 or 3 companies with optimal debt ratios of 70, 80, or even 90%. We'll talk about what causes the optimal to be different. But basically, the cost of capital approach for Disney is giving me an optimal debt ratio of about 40%. Remember that U-shaped cost of capital that you see in every corporate finance book. This is my variant of that for Disney using actual numbers. First, it's not a U, right? It's not even a V. I don't even know how to describe it. As your debt ratio increases initially, your cost of capital decreases, but only by a small amount, right? It goes from 8.07% to 7.19%. So it drops, it's good, the cost of capital is going down. But then when it starts increasing, take a look at how quickly it starts to explode out of the box. You know the lesson I get? Because this is something you're going to see on almost every publicly traded company if you use realistic numbers. What does it tell you? Not that you shouldn't borrow money, but if you're going to make a mistake on leverage, the mistake should be have too little debt, not too much debt. Because too little debt I can live with. I mean, I'll be quite honest, Google's optimal debt ratio is probably 20%. Am I going to put a lot of pressure on Google to go out and borrow money? I don't see the point. The cost of capital might drop by 0.2 or 0.3%. They have far bigger fish to fry. They can deliver far more value for me by going out and building the G car or doing something else. If you're going to be wrong here, be wrong on the right side of this graph, having too little debt rather than too much debt. Just one final point before we put this to rest. Now, I've been using Disney as my lab experiment in my applied corporate finance book going back to the 90s. The first edition of the applied corporate finance book that some of you have for this class came out in 1997. And I had Disney's cost of capital chart from that. Now, incidentally, and if you look at this chart, you can see there's something interesting about this chart that makes it very different from the chart you saw in 2013. See what that difference is? There's a kink in the cost of capital. In other words, it does what my chart did in 2017, cost of capital decreases, then it starts increasing, you're saying, looks okay, and then there's a little kink. And to show you why there's a kink, I'll tell you a story. This spreadsheet that I'm going to send you as a link that you can try for your company has been a spreadsheet that's on my website now for almost 30 years. And it gets downloaded, people use it for their jobs, and I really don't care. There's no proprietary urge. I feel there's nothing there that is magical or secretive. But people use it all the time, and I'm okay with that. So this was about, must have been at least 30 years ago, because a banker from First Chicago, there's no First Chicago left anymore, it's taken over by JP Morgan. Banker from First Chicago called. And I knew that bankers in First Chicago had been using my spreadsheet because I'd heard through the grapevine. So he calls and he says, look, I'm at a client meeting and I'm using your spreadsheet. First he says, I'm calling from a restroom. And I say, okay. And he says, I'm at a client meeting and I was using your spreadsheet to make a presentation on their optimal debt ratio, and something very embarrassing has happened. I'm thinking you're in a restroom, something very embarrassing has happened. Call your mother, don't call me. This is not the kind of thing I deal with. He said, no, not that kind of embarrassment. He said, I put up the graph for cost of capital for the client, and there's a kink in the cost of capital, very much like what you see for Disney. He says, what's wrong with your spreadsheet? It takes a lot of gumption to download a spreadsheet for free, use it for commercial purposes, have it not work, and call me and say, what's wrong with your spreadsheet? This is when I should have asked him for his social security number, his tax ID, I had him over the barrel. But I was in a good mood and I told him, and you could probably tell him too, what is it about the process by which I'm estimating cost of capital that's creating this kink, you think? I'll give you a clue. It's got to be something moving discontinuously. What are the only two numbers in my cost of capital? Cost of equity, cost of debt, right? What causes the cost of equity to change? Every time my beta changes, my cost of equity will change. And beta changes continuously. As the debt to equity ratio changes, beta moves. So cost of equity is not the problem. But think of what drives my cost of debt. What do? I look at your interest coverage ratio. I go to that lookup table and I look up a synthetic rating. So if you borrow $10 billion more and you stay in the same row in the interest coverage ratio table, I give you the same rating, even though you're a riskier company. So I told him it's because of the way I compute cost of debt. It's based on a rating, and the ratings move discontinuously. The guy wouldn't give up. He said, what can I do to make it go away? I said, two things. One is you can take that table, after all, it's a synthetic ratings table, and make it finer and finer. You know what I mean by that? Have B+++, B++, have 50 different synthetic ratings, because then you're far less likely to stay in the same row. He said, that sounds like a lot of work. I said, okay, here's the other way you can do it. I don't really need a rating. I just need a cost of debt. If you can take your cost of debt and directly attach it to the interest coverage ratio. In other words, you can come up with some kind of equation that says, you tell me what your interest coverage ratio is, this is your cost of debt. Then the problem goes away. He said, that sounds too complicated. I said, okay. I said, where is the kink in your cost of capital graph? He said around 60 to 70%. I said, where's your optimal debt ratio? He said about 30%. I said, if you made the kink go away, where would the optimal be? He said, it'd still be at 30%. So I said, why are you losing sleep over the fact that there's a kink in the cost of capital graph? Explain the process and say, that's why there's a kink. So when you do your optimal, you might get a kink in your cost of capital graph. Don't freak out about it as long as it's not right at the optimal, which almost never happens because it's not changing the end game. So what we will do next session is we're going to take this 40% optimal, and then we're going to flesh it out. We're going to talk about trying to get Disney to do the right thing with this optimal. What does it matter? Why should you do it? How does it change the value of your firm? But what I would really like you to do, and this is actually going to let you get caught up in the rest of your project almost by accident, is take the cost of capital, the optimization spreadsheet I'm going to send you for your company. It'll take all of 10 minutes. I promise you it won't take more than 10 minutes. So you'll need access to the most recent financials. And if you have the unlevered beta, great. If not, you can look it up and do it right then. It'll compute the optimal debt ratio for you. So you get a table just like the one that I got for Disney for your company. You get an optimal debt ratio for your company. It'll do everything but the laundry for you and basically said, this is where you need to go to. But give it a shot, because on Monday when we start class, I'm going to start with a question about what are you finding for your company? If any of you've got strange looking optimal debt ratios, let's start with that discussion about why optimal debt ratios might be different for different companies. That's about it. I'm sorry about the technical problems today, but hopefully the slides kind of stayed in place, even as we're doing that. But if you have any questions, I'll kind of hang around for a couple of minutes. So before I sign off, because I have to go to my next class soon.
I've got a quick question, Professor.
Sure.
With this is going back to the first half of the class, but with technology companies and their low debt levels, how much of that has to do with them not wanting to raise debt versus lenders not willing to lend money?
Most of it is them not, I mean, if you take a company like Google, would you as a banker have any concerns about lending to Google? I wouldn't. Most of these constraints are internal. Part of it is it's not in their DNA. They've never used debt. In fact, companies like Google, I'm not even sure you have a CFO, to be quite honest, because these are companies where these are companies that have had so much money coming from their base business that the finance group is kind of an afterthought. If there's a CFO, he's given a little restroom to sit in as the office. He's not high up in the decision-making hierarchy. That changes as companies mature. So this is part of the life cycle process. These companies still think of themselves as young growth companies, right? Even though they might have matured. And it takes a while. It took Apple almost 3 years to go from the recognition that they could borrow money to actually borrowing money. It took Microsoft about 5 years before they did it. It takes a long time before that kicks in. But right now, it's not a question of being able, they can borrow money if they wanted to. It's really a question of internal constraints against borrowing money. I mean, what are they going to do with the money anyway? They have a $100 billion cash balance, right? I mean, it's very difficult to think about what to do with the money when you don't need the money. Maybe something like the electric car would be what triggers the borrowing, some big infrastructure project. They've never had that kind of investment need in their history.
Thank you.
Priyanshu?
Professor, I have a quick question. So, in the cost of debt, we are mostly looking at the interest rate as the major cost, which is affecting the cost of debt. But when we are taking more debt, will other cost line items be affected? So, if you're taking more debt, we'll need something for administrating those debts
No,
or maybe
it costs you
managing.
nothing. No, wait. Administering traditional debt costs you nothing, right? I mean, it's the debt comes, so there's no administrative cost. If it is, it's minuscule. The cost that you should really worry about is the indirect bankruptcy cost, which is as you borrow money, people get wary about the kind of trouble you're in. They stop buying your products, your revenues could be affected. And that's what we'll do in the enhanced cost of capital approach. We'll look at those line items. But actually, the cost of raising capital from debt is, the cost of administering debt is a lot lower than the cost of administering equity. Right? Basically, you borrow money, you make the interest payment. So the issues we're going to have to talk about is as you borrow money, are you affecting your operating business? Are suppliers getting worried? Are your employees more wary about working for you? That's when debt starts to become a dangerous investment. Maybe at those high debt ratios, we've got to bring those costs in. Dan?
So on your slide 78, when the debt ratio is 90%, the beta is going to be almost 8. So just thinking that through, like if the market portfolio goes up 1%, Disney's going to go up 8% at that debt level, like because
not Disney. Disney's equity is going to go up 8%. So at 90%, you're essentially equivalent of a private equity investor.
So that's just because they have the odds of them being able to pay back the debt is greater. So their stock price is going to jump 8 times.
Not necessarily. Don't make that leap, yeah, right? Because you'll also come with more default risk, and all that has to be factored in. You have a much higher beta. If times are good, you're going to do well.
Okay.
Right. But if times are bad, the whole thing could blow up on you. It's the nature of any kind of leverage. It's like borrowing money to buy a house, right? A typical house, you put down 10%. You borrow 90%. The house price goes up 1%. You're right. Your equity just went up 8%, right? It's because everything gets multiplied. But if the house price drops 1%, think of it. So everything cuts in both directions. So whenever you think about the good side, hold up a mirror to the good side because it's going to be a bad side, right? Everything gets magnified in both directions. You can't run a business with a beta of 8. It's a analogy I gave early in the class. It's like building a house in a Caribbean island with no windows and no doors. As long as the weather is great, it's amazing, but you're one hurricane away from the whole thing blowing up on you. So that's basic. You're worried about the next recession because you know it's coming, and you got to get the doors and windows in, which means you got to bring the beta down before the next shock to the system. That's why when people do LBOs, what's the first thing they try to do is they try to sell off assets, bring down the debt, because you can't live at a 90% debt ratio for too long before, you're asking for trouble.
Thank you.
I'm going to have to go off, folks. I'm sorry. I have my evaluation class in a minute, so I will see you on Monday.